Hi, everyone. It's Nathan Gendelman, the Family Firm. Thank you for participating in this evening's call. I'm joined, as always, by Steve Daly, Stacey Backery here in our Bethesda offices. Again, welcome to the call. And we don't really plan it out this way, but it seemed like a pretty opportune time to chat with everyone about the world of investments and economics and everything else going on in the world. We definitely had a very tumultuous August, and even though things have calmed down a little bit in September, I think our comments and observations are quite timely. So again, thank you. And what we will do, as we generally do, is I'll just go through my thoughts, and then we'll just open it up to all of you for your inevitably, and I'm always grateful for, thought-provoking questions. So really, as we mentioned in the invitation, we just wanted to talk about, well, what's been happening with the tariffs and the Federal Reserve and the interplay between the two of them. And definitely this was felt very strongly in August. So really what we had is the Reserve and the President really reacting to each other in real time, kind of offsetting each other's moves and causing a lot of uncertainty, sometimes bordering on chaos. Just to relive the moments, there'd be many times where the president would threaten tariffs, the stock market would go down. In response, the Fed would become more dovish, and the stock market, heartened by that prospect of easier money, goes back up. And we can reverse this flow, and it did happen very often. So tensions between the U.S. and China would ease, suddenly things look better, the stock market goes up. And then seeing this, the Fed says, well, gee, there's no real reason to cut rates. So stocks go back down, back and forth, back and forth. Obviously, and from our perspective, it's pretty hard to have any kind of short-term strategy in the face of this because, again, everything is changing in real time, day by day. But really, when we step back and look at, well, what's actually happened in the actual markets over these past few months, really little change. And actually, if someone looking from a perspective of a 60-40 portfolio in August would have seen their stocks go down by a little bit, their bonds go up by a little bit, and they basically would have ended up exactly where they started. To us, and we've seen plenty of reminders over the many, many years that the family firm has been doing this, but August was about the best advertisement for diversification that anyone could ever want. So with that said, and again, all of the uncertainty and regarding many things going on in the world, nevertheless, one thing that seems to be happening for real is that the Federal Reserve is cutting rates, as they did yesterday. I guess as we think about it and what really becomes relevant in trying to manage through this and to plot portfolio strategies is why? Why is this happening? Why are they cutting rates? And should we be concerned by it? And if so, well, how much should we be concerned? So we've kind of outlined maybe three potential reasons why they're doing what they do. And I guess each one would have a different element of concern associated with it. So the first, and really the one that they have always said, they're, at least up until recently, this was the reason they claimed that they took the actions they did, was just based on the data, data-driven decisions. Whatever is happening, they will react to that and, base their interest rate policy accordingly. So I'd have to say that based on the objective American economic data, there hasn't been any reason to cut the rates. So unemployment is very low. Wages are actually rising faster than they have been. Consumer sentiment and spending is high. Now, it's true manufacturing is in a slump. That's true, but to us, that really doesn't seem sufficient for rate cuts to be put into place based on all the positives that are going on. So data, certainly one potential reason for Federal Reserve policies. A second possibility, well, what about political pressure? And I think everyone on this call knows that the White House has been barraging the Federal Reserve with, insulting and confrontational tweets and other communications. So is it possible that all the Federal Reserve is doing is just reacting to that? I would say maybe, but honestly, it seems unlikely. They've really avoided any direct responses to the provocations and really have been much less reckless, I'll use that word, than the president has been pushing for. So, for instance, yesterday the demands were for a full percentage point cut, and instead it was a quarter point cut with uncertain prospects if there would be any more. So data, maybe, political pressures, maybe, maybe not. But what is another reason they could be guiding interest rates the way they have? It's the market. That's the reason. So not necessarily talking about the stock market, but the bond market. So since really the beginning of the year, long-term interest rates have really been falling pretty drastically worldwide. Possibly due to economic stagnation in Europe, Japan, slowdown in China, all to some extent a result of the trade confrontations. And just to put this in perspective, or I don't think anyone can wrap their arms around this really, but throughout the world, $17 trillion $17 trillion of bonds have negative interest rates. Guaranteed loss of money. $17 trillion throughout the world. Most of that very recently within this calendar year of 2019. So the Federal Reserve is looking at that and saying, something is going on. And really what it kind of is the impact of the global economy on their own decision-making. As we said, well, the American economy looks pretty good, but what's actually happening globally? And that, of course, is a little bit different than their mandate, but it could make sense to think about things from a global perspective. Now, just to be perfectly frank, I'm not sure, I'm sure that I don't know, and I'm not sure that anyone knows exactly why rates have gone down as much as they have. Why are all these negative rates? I don't think anyone really knows why. But the one thing that the bond market is signaling, they're telling the Federal Reserve that things are too tight. Short-term rates are above long-term rates, this inversion of the yield curve. But anyway, all that really means is the market is saying, you've got it wrong. Your rates are too high. And I would say to their credit, the Federal Reserve's credit, they're actually listening to that. Belief is that the markets, through the collective wisdom of all investors throughout the world, they know more than the Federal Reserve governors, more than Powell and the others. And the policymakers are correct in listening to them to some extent. Again, who knows exactly why this has happened in terms of the interest rates and if they are correct in listening to them. But I would just go back and review those three potential influencers of the Fed. Strictly economic data, especially looking through the rearview mirror, political pressure, and what the collective wisdom of investors are signaling. And I would say they're probably choosing the right path. And they're definitely avoiding the absolute worst, which is just obeying the political leaders. Because honestly, if that ever becomes a perception or reality, that is the ultimate slippery slope, because confidence can disappear extremely quickly. All this confidence has been built up for many, many years from the Federal Reserve since the 1980s, really. And it could all just be thrown away very quickly. And I'm glad we don't have to contemplate that right now, because we really don't want to. because as we sit here today in 2019, the United States Central Bank is really the only institution in the world that inspires any sense of confidence throughout the investing and really the general public. So I think I'm actually just going to pause here and see if anyone has any reactions or comments. And if you don't want it to be about that, that's fine. There's plenty of other things going on in the world, from the Middle East to elections next year, and I'm thrilled to hear what's on your mind.
I had heard today that there were 3 of the people on the Federal Reserve that disagreed with the decision that was made about the rates. What does that signify?
Yeah, that's pretty unusual, really, because many times they want to present a picture of consensus. And so the people that disagreed obviously really felt that there was no need to do it. And Marilyn, really, if you just looked at the U.S. only, which is kind of what many of them interpret their job as being, is just saying to look at America only and manage the inflation and unemployment situation here. So I do see it's a tricky situation, because the U.S. economy is doing so much better than overseas, and we're seeing some weakness in exports, but definitely nothing so drastic yet. So I'm sure that's why there was some dissension. And my guess is there's some people too that don't want it to appear that they're being bullied by politics. So there could be some of that in their minds as well.
Nathan, this is Rick.
Hi, Rick.
Where do you put the potential war, Iran, and its potential today?
Yeah, well, can you mute me? Scary times for sure, Rick. And I would say, well, of course, let me talk about a couple of things. One is in many to most of the portfolios here, we do have exposure to the energy sector, which, as we saw the price of oil go up by 12% on Sunday night, Monday morning. That's just kind of a reminder of why we have that allocation, even though it's been a pretty rotten one, to tell you the truth, for the past few years. It's kind of having our toe in the water in that asset class is kind of almost an insurance policy against some bad things happening in that part of the world. And God forbid that asset class does really well, but that's kind of why we have it there. In the meantime, and we can understand why maybe the prices for energy are depressed for sure, but the average dividend yield for the global energy stocks is 5% right now. So there is some reward to that insurance policy against a big spike in the price of oil. I know I'm just talking about things from the economic point of view, and who knows about from the other aspect, just in terms of the human cost of it, which is terrifying to think of for me. And I guess I also was kind of struck a little bit, maybe, and again, maybe this is a little, admittedly, I'm talking about it more from the economic point of view, but it seems like the world of 2019 is maybe quite a bit different than it was from 1979, when we had the hostage crisis and all of that, and the things really fell apart pretty quickly economically, and there was, some pretty bleak times economically. I guess it kind of started in 78 or so and went up as far as 1980. But really, if you looked at the markets, besides the price of oil going up by a lot, the stock market basically just shrugged it off. And, it really wasn't too much effect. I know it was just one day and it was only a 12% jump, but I did think was kind of interesting, and maybe just a sign that the world's weaned itself a little bit off of Middle Eastern oil, which has got to be a good thing. So, hope for the best for sure, but it doesn't seem that economically the world is quite as dependent on stability there as was the case 30 or 40 years ago. I guess trying to, that's about the most positive aspect I can come up with, what's been happening.
Thank you.
Thanks, Rick.
Hey, Nate, I wanted to ask a question, and it related to your comments on the general funk in the bond markets globally. And can you hear me, by the way?
I think the last word I got was globally. I haven't been able to hear the rest of the question.
Oh, I'm sorry. Well, in light of the funk, the global funk in the bond markets, I was struck by remembering the presentation from a year ago where you signaled that the returns in the international markets were going to be down in the first quarter of this year. And I was curious as to whether you had occasion to go back and look at those remarks, because you had identified a number of factors for the weaknesses generally in the international markets. And I'd be curious as to how those factors look in 2019 compared to a year ago.
Well, their markets continue to be relatively inexpensive. I would say, at least compared with the U.S. over this calendar year, that many of the trends have just continued, that the economies really haven't been able to fully right themselves and to begin to really grow. And part of that is just due to their own inaction. So if we looked at Europe, really just obviously they have the Brexit soap opera, but they have the kind of the unwillingness of certain countries to loosen up the purse strings, and it's really Germany, so to actually begin to stimulate their economies, and they have, the kind of deep-seated political ambivalence towards spending, but that's kind of holding things back. And then, of course, with the other what's really been the big driver of global growth over the past decade, which has been China, and we could definitely talk for 2 hours about that, but definitely the trade policies and some of the other things that have gone on have sort of hamstrung that story a little bit, and that's held back quite a few countries that I want to say dependent on, but we're very correlated with the Chinese growth story, with a lot of their own exports and things like that. So they're kind of the lull that China's had has sort of slowed down many countries, including to a little extent United States as well. So it's probably not the greatest answer, Ed, but really there's been no drastic changes in terms of the valuation levels. Certainly, if you just looked at dividend yields or price to earnings ratios, you would still say, as I probably said 6 to 9 months ago, that they're cheaper, and they are cheaper. But the other aspect of that is, well, they have to get their earnings growing, and definitely to overcome some of the hurdles, whether they're internal or for some of the international strife, to begin to lessen.
Well, is it fair to say that a lot of those factors that you just identified are contributing to that sort of dramatic decline in the bond markets globally that you had referred to earlier, or in light of your comment that nobody really knows what's going on, are there just other forces that are at work that nobody's really identified?
There could be, and I actually I heard Michael Milken yesterday just talking about the fact that there were so many more not consumers, but investors in the financial system than there used to be a decade ago. So for, many citizens throughout Asia were just completely, had nothing to do with the financial system at all. They stored their wealth in gold or buried it in the ground, or, like my grandparents did in Russia, they just buried their jewelry under the ground somewhere. And they just weren't involved in finances at all, conventional financial system. And now with what's going on with the incredible rise in prosperity in Asia, all this money is kind of flooded into the financial system, and there's not enough things to buy. There's not enough opportunities for growth out there. But they have to buy something, right? And, people are conservative. They want to buy things that they think are safe. And they're just constantly rushing into these German bonds, American bonds, Japanese bonds, and just this cascade of money chasing the yields, keeps pushing the yields lower and lower and lower. And that could be an explanation for some of it. It certainly makes some sense to me. And the other possible reason is, the more pessimistic one is that, well, just looking at these countries in the world, they're just not going to grow. There's not going to be any inflation. There's not going to be any growth. So therefore, let's just lock in our -7% on German bonds, and that's as good as we can do. That one seems a little bleak and a little perhaps overly pessimistic, but again, no one is quite sure. And I think, as I was saying it, and even as I've heard it recently, the first explanation makes a little bit more sense. It does mean that much of the world is not making very savvy investment choices, but that could well be what's happening. And I think, for better or worse, it is kind of creating an environment where businesses and individuals can borrow at very low rates, take advantage of these folks throughout the world that want to save and have ultra safe investments. And that's kind of creating an environment where really, if they wanted to, and Lord knows the United States has been taking advantage of this, to borrow at extremely low rates, and companies as well. And the fact that if Apple can borrow for 15 or 20 years at 2% or less than 2%, I guess we'll find out in 10 years. But it seems like a reasonable bet that they can make more than 2% on their investments over a decade.
Yeah, those are all fascinating insights. Thank you very much, Nate. I appreciated the presentation tonight.
Thanks, Ed.
So is this getting to be a time when we should refinance our mortgages?
Probably. It depends when's the last time you refinanced it. We're getting pretty close to the 2009 levels, I think. They've gone up a tiny bit, but we're definitely at a pretty good rate. And I know within the last 6 months, there's been a tidal wave throughout the financial system of refinancing for people that maybe had bought in over the past few years. So we had the United States 10-year bond get down to below 1.5% a week or two ago. So that's pretty low. And actually, I think that's the lowest. At one point, I think maybe it was for the 30-year, but I believe it was at the lowest point it had ever been at the entire history of the nation. So certainly that's a refinancing opportunity. Things have gone up a little bit since then in terms of the rates, but it's hard to imagine going wrong getting a mortgage at these kind of rates that are available now. Any other observations or questions?
Yeah, hi Nate, this is Andrew. I had a question about energy. You talked about conventional energy, but with the with the politics of energy and climate change, and excluding the unstable things like Tesla, what opportunities are there in alternative energy that you think are going to do well over the 5 or 10 years?
Well, it looks like the costs are tumbling so much. Forget about coal now, but in many cases for the consumer, the renewables are at the level of the fossil fuel. So yay, that's finally happened. Looks like the long-awaited, arrival of that has finally happened. I think it could end up being that consumers are the biggest beneficiary of it, which is great, and the environment as well. It's been a little tricky to invest because there's not that, well, the problem is there are so many makers of the solar panels, for example, and most of them are in Asia and are very difficult, if not impossible, to access from the investment side. And the other issue that seems to be happening from the perspective of an investor is that it's a very ultra-competitive industry, and the margins are extremely low, if not zero, to make the panels and to make some of the other things. And it's going to be very difficult to make a good investment return from making a lot of the hardware for the alternatives right now, just because there's too many manufacturers cranking them out, and the market hasn't been able to absorb them all. It's an extremely similar situation to what happened in the electronic era when that was just getting going, and there were 50 to 100 companies in Japan making radios and transistors and things like that, and just too many. And it's great for the consumer because the consumer is really the only one that benefits because it pushes the cost way down. But from the investment standpoint, wow, unless you had that one company, unless you had Panasonic, it didn't really work out. And even then, they were still battered by the competition until they could just, swamp up everybody else. And now from our seat here, it's really impossible to know who would be the winners and the losers in that. Besides, if the technology can keep advancing, all of society will get a big advantage out of it. Any other thoughts or observations or things that you want to make sure we've got our eye on? All right. Well, we promised to keep our eye on the ball anyway. So, so what we do is what we traditionally do is post a recording to the website, and then we send out an email with a link to it. So today being Thursday, it might be early next week at the latest, but we'll definitely contact everyone via email to let them know they can click on the link and listen to everything at their heart's content. So thanks everyone, and have a great weekend coming up, and we will be in touch soon.
Thank you.
Thank you.
Great. Thank you, Nate.
Thanks.
Thanks.
Right.